session before the break, we heard about the 10x growth, rather 27x growth. But all growth requires finances. However, we all know that Indian companies are really reluctant to borrow in or give up their equity. So what are the options with us? To answer these questions, I would like to introduce Lord Ghadia of Northwood, the youngest Briton of Indian origin in the House of Lords. He's an investment banker who holds senior position at Blackstone, Barclays Capital, ABN AMRO, and Baring Brothers. He's on the board member of both the UK government investments and UK financial investments. He helped craft the Prime Minister, Mr. Narendra Modi's speech at Wembley Stadium. Yes, that's Lord Ghadia for you. Can I ask Lord Ghadia to come on stage and introduce his panel?
Thank you, Ekta, for your kind welcome and introduction. And it's a pleasure to follow my good friend, Nikhil Rathi. I think in the answer to the penultimate question somebody asked about his own background, I think he was being very modest. I think he is definitely a rising star in the UK, and I think he demonstrates how you can span both the public and private sectors. And it's an honor for me to participate in this JITO conference. The reputation and business acumen of the Jain community precedes itself. And frankly, given the achievements of the global Jain community, you should actually be teaching all of us lessons. But such is the humility and I would say spiritual underpinnings that you are on an eternal quest for self-improvement and on a mission to quench your thirst for knowledge. And I see knowledge embedded in your logo. When I first saw this topic about financing 10x growth, I think it's gone up to 27, I hear, in the meantime, my immediate reaction was that most businesses would be more than satisfied with even 2 times growth, which would represent a significant achievement in its own right. So I guess that only the Jain community can be so audacious as to dream of 10x growth. It's the ultimate stretch goal and echoes a management concept first popularized by London Business School professor Gary Hamel and C.K. Prahlad, the late C.K. Prahlad from Michigan University, in their famous Harvard Business School case study almost 25 years ago. So to explore this topic, we have assembled a great panel who I will introduce shortly. But before I do so, I want to set the scene and share some views on the mega trends which are shaping the current financial market, which provides the backdrop to our discussion over the next, I think we've lost some time, so maybe over the next hour or so. And we hope to take as many questions as possible from the floor after the initial contributions. So let me first start by commenting on the macro environment influencing the financing markets. It seems like the world is at a crossroads with the beginning of the end of an unprecedented era of quantitative easing, which has pumped unprecedented liquidity into the financial system. Central bank balance sheets have trebled in size over the last decade and now stand at over $20 trillion. To put that into perspective, that's more than the size of the US economy measured by its GDP. And as central banks start to wean the patient off the morphine, it will inevitably make some financing markets tighter going forward. So with hindsight, this could actually be an incredibly good time to raise finance. As with many things in life, you should always do things when you need it the least. Interest rate cycles are at different stages across the world, having already tightened in the US. attention is now shifting across the Atlantic with all eyes on the Bank of England next month. And by way of contrast, India has been on a gradual loosening of monetary policy by the RBI, with the possibility of more rate cuts to come if growth and inflation remain subdued. There's also a strange paradox in global markets at the moment. While all the geopolitical uncertainty is self-evident, the VIX index, which measures market volatility, also known as the fear gauge, has hit record lows and is trading below 10, which is half its long-term average. This is another sign of the historically benign market conditions. Within this macro context, I wanted to highlight 5 mega trends covering the major categories of financing. The first mega trend is the downsizing and deglobalization of banks over the last decade since the global financial crisis. The McKinsey Global Institute has just published a report showing that cross-border capital flows have shrunk by 65% since 2007, with half of that decline coming from a reduction in cross-border lending, being filled by the emergence of alternative non-bank providers, such as credit funds and insurance companies, as well as peer-to-peer lenders and crowdfunding platforms. Also, the tax-efficient status of debt funding through loan interest being tax deductible is coming under increasing challenge. So whilst banks might still provide a good source of ongoing working capital and asset-backed lending, it would be frankly fantasy to rely on this traditional source to fund 10x growth, let alone 27x growth. The second megatrend is the continued growth of debt capital markets, which has accelerated in those regions of the world which have previously relied more on bank financing. So in 2016, there was a record issuance of $7 trillion in various types of bonds, of which half was investment-grade corporate debt. The third mega trend is the resilience of public equity markets, and you heard Nikhil's presentation beforehand. They have remained strong and buoyant in virtually every single country. The MSCI World Index has risen 16% this year to date, and the MSCI Emerging Markets by 28%. The forward PE ratio of this index is 16 times, which is the highest since 2004. So this is undoubtedly a seller's market when it comes to company valuations. The fourth megatrend is a turnaround in the fortunes of the private equity industry, which went through a rough patch between 2007 and 2011 with dramatically reduced appetite for leveraged loans and high-yield financing. Since then, the sector has demonstrated the ability to exit historic investments at very attractive valuations, and the financing market is now back in full force. As a result, most private equity funds have made net distributions to their own investors or LPs and have been able to raise new funds, and there is now $1 trillion of dry powder ready to be deployed. The main challenge now is actually high valuations and the ability to deliver expected returns. And finally, the fifth megatrend in globalization is the globalization and deepening of the venture capital sector. Until a few years ago, the VC industry was still a predominantly US-centric activity by value and volume. There is now more prolific venture capital activity across the world at every stage of the cycle, and the ability to raise very large fundraising rounds prior to IPO or sale. The establishment of the $100 billion Vision Fund by SoftBank in London is a testimony to this trend. I'm conscious that our audience today will be drawn from many different geographies, industry sectors, and different stages of business maturity. So there are hazards in generalizing. But almost by definition, if you're looking at 10x growth, then you need to look beyond traditional bank finance towards different types of risk capital. And you can see from my remarks that both the private equity and venture capital markets are flush with capital. Accessing external capital immediately raises a triangle of interrelated issues revolving around dilution of ownership and control, valuation, and governance and organizational preparedness to receive third-party funding. And this is even more acute for family-owned businesses. And to help us address these and other aspects of the financing puzzle, I am delighted to introduce my three fellow panelists, all of whom I have had the pleasure of knowing for some time. Firstly, please welcome Nina Amin, Nina is a partner of KPMG and head of Asian markets. Nina is the senior-most Indian female at any of the big four accounting firms and has worked closely with many family firms and specializes in taxation. Secondly, Dixit Joshi, recently appointed Group Treasurer of Deutsche Bank, who has also spent time in different areas of investment banking, including equities, equity derivatives, prime finance, and fixed income, and has previously worked with Barclays Capital and Credit Suisse. And thirdly, and certainly not finally, Hussein Kanji, founder of Hoxton Ventures, a European early-stage venture capital firm which is rising rapidly in prominence and demonstrates the globalization of the sector. Prior to this, Hussein has spent time at Excel Partners and Microsoft. Please welcome the panel members. So, turning, if I can, first to Dixit. You've worked consecutively for two universal banks, Barclays Capital and now at Deutsche Bank. And I made some remarks about banks in terms of the first mega trend that I described. Are large banks still the first port of call for financing? And how can you make yourselves more relevant to your clients?
Thank you, Jitesh. Good afternoon, everyone. I'm conscious that we're standing between you and lunch, so we'll try to keep our remarks as short and succinct as possible. In answering that, I think, Jitesh, it's important to look at the needs through the lens of the client. And what are the needs that business people, successful business people, growing businesses like yourselves need? And I think there's a number of elements to this 10x when you look at it. And it's all fine to focus on the top line, but if your top line growth outpaces your ability to function efficiently and you can't manage the operational risk, then both the operational risk and the cost of any errors later will increase exponentially to you. And that would be quite a shame when you've actually spent the time laying the foundation, come up with a business plan, successfully started implementing it, but haven't planned adequately for your growth going out in time. A number of things that you've got to get right, and I would say at the beginning, it is cliche that we should be thinking about your growth holistically, but if ever there was a place to do this, it's in a fast-growing business environment. When it comes to financing, very important that your balance sheet is exactly that. That it is balanced, especially when you're rapidly expanding. In terms of the choice, and clearly important to get right the mix between debt funding, equity funding, as well as traditional bank lending, that will be very much a function of your appetite to relinquish control. Depends where you are in terms of your family cycle, if you're a family-owned business. how comfortable you are with increased transparency and having the look-in from external investors. So I think it's a fairly complicated question, especially when it comes to family-owned businesses. The second is, and maybe would be useful here to get a quick show of hands, how many of you import externally from outside your home country? How many of you export externally from your home country? So, fair to say that you have a fairly international mix here in the audience. And as you grow your businesses, whether it's 10 times, 20 times, seldom will that be within your domestic market. It's highly likely that you will be either importing more from countries or exporting more to others. And with that comes a series of risks. And important when you have those risks, that you have a partner that you can manage those risks with. Now, those might be as simple as the cultural nuances in each of the markets that you're in. But as we've seen by some of the uncertainty that's come up here due to Brexit, also legal uncertainty and contractual uncertainty in some of these markets which you might not be familiar with. It involves physical on-the-ground support and really your ability to carry on doing your business through potentially some of the changes that Jitesh mentioned as we see a change in the rate cycle, which could cause changes especially in emerging markets. Then I would say you need to look at your growth through the lens of risk as opposed to necessarily just your top line and your growth. So where do your risks emanate from? It may be well and good to put in place a financing program for the next 2 years, but if you're out of your J curve and much of your expansion comes through in years 3, 4, 5, have you put in place adequate funding, or do you have a contingency that you can rely on precisely at the time when your business is about to take off? Bad things can happen to good people. And what I mean by that is unforeseen circumstances, especially in the markets, when you're dealing with global businesses, risk emanates from places that you least expected. So an example would have been, we deal with a large mainstream country, volatility is fairly low, we don't really have a lot of risk. Look at what happened with sterling post-Brexit, which was quite an unexpected outcome to many, including us here. Look at what happened when the Swiss franc depegged, again an unexpected outcome. So think of your business plan together with some of the risks that you run. When it comes to how you manage and mitigate many of these, and that really gets to the heart of the partners that you have across the globe, it's important that you have access to the widest, most diverse pool of funding. Now, whether that's bank funding, whether that's private equity funding, or whether that's the public markets, being able to tap a diverse set of investors. You may have a preference for strategic investors as opposed to financial investors. It's important that you have a partner that you're able to deal with across all of those. When it comes to managing markets and financials risks, and I know derivatives in the last 7, 8 years post-crisis have gotten not the best name as we've come through the crisis, yet use of simple derivatives is one of the most effective ways to manage some of your risks that you have. So in closing, Jitesh, I think incredibly important that you have a partner that can cover all of your needs, because as your businesses get more complex and as you become more international, your needs by definition grow.
Thank you, Dixit. Let me now turn to Nina. You've have some very deep experience of helping family-owned businesses. Maybe I can ask you to share your views on the challenges, particularly of financing family-controlled businesses.
Right. Thank you, Jitesh. Good afternoon, ladies and gentlemen. It's actually wonderful to see such a fantastic turnout here this afternoon, and I hope that I and my panelists can share some useful insights into achieving 10x growth. We at KPMG for the last 5 years have set a target of achieving 6% growth per annum, and boy, have we struggled with it. So to me, anyone who has the vision, the strategy, and the markets to aim for 10x growth is absolutely inspirational. So bearing this in mind, What I would like to do before I sort of share some insights with you is some audience participation. Now, don't get excited. I'm not going to ask you to dance or to share your deepest secrets. What I would like to do is just a show of hands. So can I ask, how many in this room actually run your own business? Wow. So over 70%, I think, right? Okay. Of those, how many are family owned? Right, a very high percentage is family owned. How many of you have started a business in the last 2 years? Okay, so a lot of startups, that's good. How many of you have got bank funding? Not that many, actually. That's interesting, not that many. How many of you have got non-bank funding? 1, 2. Okay, and how many of you would require more funding? Great. So it seems as if all of you require, more or less, all of you who are running your own businesses require more funding. KPMG did some research recently into family businesses, and I'm going to share some of the findings with you because they make really interesting reading. Did you know, right? Did you know that that family businesses contribute over 70% of global GDP? Global GDP, right? 70%. And that they make up 1/3 of Fortune 500 companies. Isn't that amazing? So family businesses are very, very important to global growth. What we also found is that family businesses require finance, just like any other business, finance to fund that growth. And the majority of these businesses are looking for external funding for both short-term and long-term growth. Interestingly, we found that many family companies were willing to offer equity as long as they could maintain their controlling position and retain their strategic independence. So control and independence are very, very important to family businesses. Tell me if that sort of resonates with you. Just show of hands if great, okay. We also found that not only retaining majority ownership was important to family businesses, but that the vast majority of family businesses were reluctant to sell their businesses or to give up control. So now that makes really interesting. If you are actually looking for funding, right, you do not want to give up control, you do not want to lose your independence, then that somewhat makes funding a little bit complex. So, what are the challenges facing, given those circumstances, what are the challenges facing family businesses in getting funding? I think one of the first things when you're looking for funding is that you need to consider, right, how much you need. Are you prepared to pay for the interest, right? Can you bear or afford to pay for the interest costs? Are you willing to give away your equity? And believe me, you also need to know if you are borrowing funds, how are you able to repay that loan? Because you will find that that loan becomes repayable sooner than you were anticipating. You also need to consider what your risk profile is. How much risk are you prepared to take when looking for external funding? And believe me, entrepreneurs are the most optimistic people I've ever come across. All they see is the upside in their businesses. They don't see the downside or the risk. And that's why you need people like myself, a chartered accountant, and Dixit, a banker, to assess the downside in your business and to advise you accordingly. So I think it's very important when you're looking at that 10x growth to actually balance the risk and the reward to your business, because you could end up losing your business. And I've seen examples where, because of inadequate financing and inadequate forecasting, people have lost their businesses. Now, as I said, accessing growth capital is extremely complex. And then it becomes even more challenging for family businesses because of their tendency to want to maintain control. So therefore, it's very, very important that you understand what an investor or a banker will seek when they want to finance your business. To be clear on what is acceptable to you and your business. And with this in mind, to position yourself attractively to secure the investment or funding that you need. Now, I think a cultural obstacle for family businesses is the need to open itself, right, to outside scrutiny. Because no matter who you're getting the funding from, they will want to do the due diligence into your business. They will want to look at your books and they want to look at your accounts. They might even want a seat on your board. And they might want to have some influence on running your business. It's important to evaluate the investor's likely requests with an open mind. After all, they can bring new insights, experience, and contacts which can help you achieve that 10x growth. Now, what we found actually is, the best for family business, the best or the most attractive investors are the high net worth individuals. And the reason for this is because the high net worth individual have a lot of experience because they've already made the money. They also have a long-term expectation of realizing their investment. They have shared values with family businesses. And that is very, very attractive to family businesses. In fact, 92% of family businesses that were lucky enough to secure investment from high net worth individuals found that that experience was much better than getting finance from any other sources. For new startups, and I think there were quite a few in the room as well, because they are startups, because they haven't got a track record, it is more difficult to attract funding. But it's getting easier now because there are new forms of funding that are available. For example, you have crowdfunding. How many of you have heard of crowdfunding? Great. And also angel investing. So I sit on the board of an organization called TIE, and we've actually set up an angel fund which will invest purely on startups because we want to encourage entrepreneurs who have great ideas, great prospects, but absolutely no track record. And they do not want to pay an arm and a leg to secure other sorts of funding. So angel investing is becoming very, very attractive. And people should look at that. Family business in particular and startups in particular should look at it. The other form of funding as well is, and this is extreme, but we've done it before, is whether your business is ready for a listing. You heard from the chairman and the CEO of London Stock Exchange. And we at KPMG recently helped a scale-up business to list on the London Exchange, and they became the first retailer to IPO earlier this year. Now that does mean that you need to tidy up your business, you need to make it attractive for investors, you need to look at your structures. And those are some of the things that family businesses struggle with, because my experience is they have a very lean finance function. So therefore, they're not quite ready to do all of those things. So one of the first things they should consider doing is beefing up the finance structure. So I hope that gives you a little bit of insight into the challenges facing businesses. One other thing which I should mention is, how do you value your business? Say you're looking for funding and you want an outside investor. How do you value your business? you need to be realistic about what your business is worth, all right? And you might value it at sort of future time sales, you might value it at earnings. At the end of the day, it's how much a willing buyer wants to pay for your business and what is acceptable to you. So I'm going to summarize by saying that there are many challenges facing businesses in general and family businesses in particular. But the starting point will always be how much money do you need and how long do you need that money? And once you've decided how much you need, then decide whether you want bank finance, venture capital finance, equity finance, angel investing, crowdfunding, VC funding. There's so many options available. Evaluate them and then decide what you want. Also make yourself more attractive to investors. So for example, there are a number of tax reliefs that are available in the UK if you're investing in a UK company. For example, you've heard of SCIS, which is relief for seed investors, as well as Enterprise Investment Scheme. And because of these generous tax reliefs, it makes it more attractive to investors because it reduces their risk of investment. So look at those as well. Make yourself more attractive to investors. And finally, whoever you take on board, whether it's a bank, whether it's an investor, make sure that their interests are aligned to your interests. Very, very important. Thank you.
Thank you, Nina. That was some great, very practical advice. Now we're going to turn to Hussein, who actually probably is the closest that the panel will actually genuinely get to 10x growth, because that's his business model as a venture capitalist. And Hussein, you also heard, I think, from a number of, we have a predominance of family-owned businesses here as well. Can you share with us maybe, how venture capital can be accessed most effectively, and also maybe particularly in the context of family businesses tapping into venture capital?
Sure. So good afternoon. I run a small venture capital firm here in London that invests primarily in technology companies. Probably our most noticeable company now is a company called Deliveroo, which when I invested in it was doing tens of thousands of revenue a month in terms of restaurant sales. It's now doing tens of millions, almost close to 100 million a month in revenue sales in less than 3 years. So that's a little bit more than 10x revenue growth. Those are the kinds of businesses that we look for and try and back. We run a very quirky investment strategy by most contemporary measures compared to other kind of financing strategies. So venture is all about finding very large asymmetric return type of businesses where a little bit of money will catalyze the business to not just become a healthy business, but a really, really large business in the long term. Those are very rare. They're very hard to find. They usually come on the back of brand new market changes, where a group of entrepreneurs, usually around the same time, will spot an opportunity, a market disruption, and then try and build build several different variations to try and target that market opportunity. Usually these things happen globally because our businesses tend to be global businesses. The technology playing field these days is very level in terms of accessing the global markets. So you end up investing in these kinds of companies, and you're trying to pick the number one company in that product category or that market category that will rise up. We, unlike many other financiers, really don't care that much about failure. The average venture capital firm will fail. Failure being we lose our money.
Sorry, no need to panic. That's I think an alarm test, so it'll go in a second.
Nothing you said. Great. You speak about
Don't worry, we're actually right next to the MI6 building, so there's no need to panic.
You speak about failure, the alarm bells go off, right? So that sounds like very London. So the typical venture capital firm will usually lose money about 45% of the time on its investments. The really good venture capital firms usually will lose money about 55% of the time on their very good investments. And the bad venture capital firms lose their money about 25% of the time. So what this tells you is that the really good venture capital firms, which generate the bulk of the returns, fail more often, but when they win in a much, much, much bigger way. Our cost of capital is very high. It's about 30% per annum. So we need to, and we lock up our money usually for 10 years for our investors. So we're trying to return back 4, 5, 6 times investors' capital over that 10-year horizon. What that means is that we're very long-term, we're very patient. It takes the average firm about 7, 8, 9 years to be able to do a public market listing to become a big type of company. We're okay with waiting. We're very okay with failure, as I said, and we tend to finance the company all the way through its life cycle as it raises more and more money, usually from external financiers. It's not a market that I think is extremely suitable for family businesses, unfortunately, because I think family businesses worry a lot more about cash flow and about survivability and viability of the market. The market, I think, for family businesses is more of a peer of ours, which is growth equity capital, which looks at companies that are generating revenue, that are able to generate earnings or be able to show that they're able to generate earnings. Don't take the same kind of risk profile that we do in terms of backing companies, from concepts. They back healthy companies and then try and grow them with the family. But the other characteristics, I think, are very similar. Most of us, whether we're on the growth side or on the venture side, realize businesses don't get built overnight. They take years. Most of us realize that these are partnerships. Depending on the growth firm or the venture firm are almost always minority investors. We have no interest in running a business, controlling a business, taking a majority interest in the business, because the truth is, if the business actually scales, at some point the person who's running the business wakes up and says, you know what, I'm not going to get really wealthy off of this, and I'm going to leave, and if they leave, the business falls apart. Most growth equity firms are also minority investors, but probably a little bit of a healthier minority than we do, because they don't get the same asymmetric returns that we do. So we tend to be long-term, patient, very partner-driven investors. And there's a whole bunch of us now in London, so it's fairly easy to find us. The best way in our community of finding us is to come through a referral. We use this as kind of the first litmus test. Our world is very connected these days, and it's very easy to find someone who knows someone at a venture firm and get in the door. If you can't do that up front and actually find someone through a referral, it just means you don't really understand the rules of the game, and it's hard to be able to build a business with someone who doesn't understand that it's actually fairly easy to get a referral in the door. But our doors are always open. We have no idea, legitimately no idea. We get this question from investors all the time. We have no idea what we're going to invest in over the next year or two. We look for really brilliant people, really brilliant markets, really brilliant ideas, and if we see them, we're good at figuring that stuff out and then writing a check. So that's kind of how we operate.
That's great. I think what we'll now do is we'll try and make this a bit interactive. So let's take some questions from the floor. If I can get you to put up your hands, maybe say your name and affiliation, and ask your question. We cannot have stunned the audience into silence, so somebody must have.
So there, Jitesh.
There we are at the back.
Good afternoon, sir. Very good insights on all four of you, sir. I am Ankur Jain. I'm an investment banker from Mumbai. I would like to see how, as an investment banker from India, we have the opportunity to bring out corporate clients out in London who are a good potential clients and customers, wherein and how do we target Indian London investors to invest in Indian corporates?
Dixit, why don't you try that one?
Sure. I mean, look, we heard from Nikhil, who talked about London being a premier venue for capital raising for international companies. London, as you saw, raised more money for international companies than any other European exchange. so far this year. So we're not short of investors here in the UK. Generally, UK investors are extremely comfortable with businesses that have an international flavor. If you look at some of the top names in the FTSE 100, a large proportion of their earnings emanate from outside the UK. They're also familiar with the top tier of Indian names, perhaps not all of them, but there is a fairly wide market here in large cap investors who track, for example, MSCI emerging markets, and they would touch all of the top counters in places like India. But then there's also an ecosystem of smaller funds which focus on small cap and medium cap companies across the globe. So I think tapping into that isn't particularly difficult, but I don't know if that answers the question.
Great. Shall we, Yeah, on table 15.
My name is Manish. I'm based in UK here. My question to Hussein, you do invest a lot of money in tech companies. There was some conversation by Nina also, valuation of the company. So how do you value a tech company? And for example, I am developing a company, so make it more valuable, what need to be considered?
So I mean, the traditional answer to valuing a company would to be build a big discounted cash flow model, and figure out what the earnings potential of the company are on an ongoing basis, and discount back to present value. What we've learned is that's mostly a garbage in, garbage out exercise. If you're a small company, your idea of projecting out even 2 years out, 3 years out is probably nonsense. It's all speculative. It could go either way. You could do much poorly than you anticipate. You could also do much more fabulously than we anticipate. I've reread our investment memo on Deliveroo several times as its subsequent financings have happened, and we couldn't predict what the growth of Deliveroo was going to be, let alone the company. So the DCF model doesn't really work all that well. And then one thing about DCF is almost all the value is in a discounted cash flow model is in terminal value. And terminal value is kind of nonsense in the tech industry because it's very hard to figure out what terminal value looks like. If any of you can tell me what the terminal value of Uber is with the rush of self-driving cars, none of us even know if in the long term Uber is viable or not viable, not because of anything that Uber is doing, just we don't know where the market's going to be in 10 years. And then you have such a chunk of value locked up in that model. So the way we usually do it, and it's when you do the academic approach, there's some options models and it gets kind of complicated. It's really easy. There's cash in, right? There is a price that clears the market with the entrepreneur. We tend to want to own somewhere between 15 to 30% of a business. If it's a very competitive deal, it might go a little bit below 15. If it's less competitive, it might be at the 25 to 30 mark. If there's a very healthy market, as in they get offers from multiple people, then obviously we end up having to push our valuation up. We spend a lot of time thinking about how much money the company actually needs to show that at the next point in its life cycle, which is usually about 12 to 18 months in technology businesses, where it would be able to raise financing from. So what we tend to, if an entrepreneur asks us, say, for $1 million, but we think it's going to take $2 million to get to the next milestone, we'd much rather write a $2 million check than a $1 million check, and then would adjust evaluation accordingly, because what we want to see is the next time the company goes into the market to raise money, it's at a significant step function over and above where we are. You work backwards from all of these kinds of things, so you figure out the competitiveness, you figure out how much money the company needs, and you figure out the price at which it clears. You kind of come to a number that kind of makes sense. And then you spend a little bit of time thinking about, if all the pieces, again, remember, we're not so worried about the failure case, we're worried about the upside case. So if all of these pieces kind of fall into place and the business is only going to really be worth $50 or $100 million, interesting, but if you really believe that this company could be worth $5 or $10 billion, right, will that 10% or 15% or 20% ownership be quite material when you exit the business? Because that's what generates our returns.
Thanks, Hussein. That's probably a counterintuitive answer. You wouldn't have thought that valuations are based on the supply and demand of capital and cash burn rather than intrinsic value, but effectively that is the VC business model. Maybe, Nina, can I also get you to comment on valuation? And obviously, there are businesses that aren't necessarily at the VC or early stage, but other businesses but actually where more, typical valuation techniques might be helpful. What's been your experience on how an external valuation can help, maybe even particularly family-owned businesses?
Yeah, okay. So, we do valuations at KPMG, and there are different types of valuations as well. So we do a lot of valuation, so for example, when somebody is looking to raise funds under a tax scheme, we do tax valuations. And those are very conservative way of valuing it. If somebody is looking to actually exit a business or doing some succession planning, then we look at a sort of a more commercial way of valuing the business. And the sort of things that we take into consideration, very much, what is your price earnings ratio, not just historic, but really look at the next 2 to 3 years and then value it at X times. What's the average in the industry? So, for example, if you're looking at a retailer, what is the sort of the normal price earnings ratio for a retailer? Is it 10 times? Is it 11 times? And we would then apply that to prospective earnings, right? We could look at, for companies where there is no earnings, and there are so many startups and technology companies that haven't made a profit ever, and yet they are worth a lot because they have a technology which is going to transform the business. So if you actually look at WhatsApp, that got valued at 10 billion, and that was just purely on what the buyer thought it was worth to them, rather than what sort of actual valuation that anybody else had sat down and done. And that was actually saying, okay, this is the X number of users we have, and this is how we can market them. At the moment, it's not making any money, but they will make some money. So there are so many different ways in which to value, but as I said, at the end of the day, it's very much about what a willing buyer is willing to pay for that business, and is that acceptable to the seller?
Yeah, Nina, you make a very good point. Ultimately, value is like beauty. It's in the eye of the beholder, and it's basically what a willing buyer and seller will consent on. Maybe I can, just because we're on this valuation theme, Dixit, Deutsche Bank obviously has got very deep market presence, and I referred to earlier that I thought it was currently a seller's market in terms of valuation. What's your sense of the markets and valuation levels, obviously, across different asset classes, but particularly for businesses?
But you're right. It's a very interesting time because the world is awash with capital. So to Hussein's point, it's not very difficult to go to find the capital. The pools of capital now that exist are significantly larger than we've ever seen. If you think back to 2007, you had a large amount of capital concentrated within, call it the formal banking system, and now you have a large amount of capital, private capital, that's allocated to the markets. It used to be the case that your only venue for financing was typically to go to a bank, and now you have shadow lenders who are very comfortable providing very large ticket sizes, individual ticket sizes to SMEs and other corporates themselves. So the financing landscape has changed dramatically, and that's to the benefit of all of you in the room because your avenues for financing are much wider than before. In terms of the market, the markets, and as we're seeing now with the S&P at 2,500, and you've seen the rally that we've had, markets are actually in robust shape. Now, that's not saying that we won't have a sell-off. That's not saying that the turn in the rate cycle won't cause an adjustment. It definitely will. But when you think about pockets of leverage which can cause issues, there's fewer pockets of leverage than in 2007. If you look at emerging market corporates, they're very conscious of the foreign exchange risk that they run. They've been very careful not overloading on non-native currency debt. That's also been done at the sovereign level, where the sovereigns, especially in emerging markets, have been managing themselves quite well. So the likelihood of a 2008 style event in emerging markets is significantly diminished. Doesn't mean the probability is zero, but the likelihood has gone down. Potentially where we might see some issues is in places like student debt, auto finance. Those are the sorts of pockets which, as a function of cheap monetary policy, we've seen an explosion of that, and I think that's where we might see problems. It certainly isn't in the equity space right now. So if you're looking for capital and the story is compelling, there's a wide pool of capital out there which is looking for opportunities.
Thanks, Dixit. I mean, I'm tempted actually just to complete this and go back to Hussein. A lot of people would say that the VC valuations are getting very toppy, that particularly the tech market is going through a bubble flooded with cash. What's your view?
Yeah, so I think I do believe that we're in a bit of a market inflation. I think there's too much money in the world chasing after too few opportunities that will generate results. The WhatsApp acquisition actually closed at 24 billion, and I know the guys behind it. It was because it was a banker who had it on their list of potential targets and showed it to Facebook, and they kind of speculated that this company would be worth about $6 billion as it grew up and got to scale. Somehow or another, Facebook got spooked that Google was going to buy the company, and it got into a competitive bake-off, not knowing that there was no other party on the table, and took the price up to 19, and by the time it actually closed, it ended up closing at 24. We have large technology companies that have deep pockets of cash. For them, these are despite the fact these sound like really big numbers, they're rounding errors for these kinds of companies. We're in very competitive technology markets as well, where it's very clear if you look at the list of like leading technology companies 15 years ago and you make the list today, they look totally different. Microsoft and Intel are not really in the picture anymore. Intel definitely not. Microsoft is fighting for relevance. So the world has become a lot more competitive. And these businesses are phenomenal cash flow businesses. Both Amazon and Apple, as well as Facebook, generate a ton of cash that they can use to be able to buy things. And then there's a lot of money that's come in from the private sector to go into this asset class because it wants to do things. The Vision Fund is an example. Mubadala setting up a venture fund. In my mind, whenever the Saudis decide that they're going to become tech investors, you kind of can call the top of the market.
Should we go back to or take questions from the audience? Back there, gentlemen. Just wait for the mic.
Hello, I'm Santosh. There is a lot of interest parity between India, what we have and what we have in foreign countries. Like LIBOR is around 1% and we have an interest rate in India around 12 to 15%. So I think most are relevant to most of the businesses, how they can access so that cost of financing or funding their business. How can the delegates access this parity and take the advantage of this?
So if I get your question right, how can Indian businesses take advantage of lower cost of funding from international markets?
The interest parity.
Interest parity.
Between what is lying in India and what's available overseas compared to LIBOR. How we can take the advantage, because that's a big difference.
Fine, maybe, obviously there is an established external commercial borrowing sort of framework for Indian corporates to borrow. So maybe Dixit, you guys are probably very active in this field. What's your view?
Yes, I'd just say there's no free lunch. So if you're thinking about, for example, a seeming difference of a couple percent and looking to borrow in dollars, my question to you is, does your business plan actually have, for example, revenues in dollars? Do you have expenses in dollars? Are you running a dollar balance sheet as well as a rupee balance sheet? And how mismatched are your assets and liabilities? And if we did have, God forbid, a move in the rupee to 75, 80, what would that do to your business plan? Would that mean you would shutter your factories? Would it mean that you would not have capex to complete on projects? Would it mean you'd get hit with penalties if you're in the infrastructure space and you can't complete on projects? So I would think about it in that lens. As a complement to your portfolio, if it made sense, absolutely, by all means take advantage of it. It's not an arbitrage, I guess, is what my point on this is.
Yeah, the point on currency risk, I think, is very well made, and a lot of, frankly, financial investors have been burnt as a result of this. I see more questions. Yes, the gentleman here.
So, question. You know, there's huge pools of liquidity and capital in China, for example, and maybe to a lesser extent in India. Are you actually seeing any Chinese companies coming here to raise capital, or is it not really necessary?
Who wants to take that? Go for it, Dixit.
I'll take it. Of course, Rajiv, by being one of the large pools of capital himself, yes, from a Chinese perspective, I think there hasn't been really a need necessarily to raise a huge amount of capital in the US or in Britain. It's really been the other way around, which is outward flows seeking acquisitions. Now, to be fair, that's been tempered, as we've seen most recently with this pullback on conglomerates investing offshore as a result of some of the scrutiny that the government's putting on them right now. If ever, there was an opportunity for them to raise capital, Hong Kong, was the premier venue for them. And for tech companies, it was New York, but we've just seen that deal flow slow down.
Yeah, and I suppose Alibaba is probably the prime example of that, but I think it's particularly sort of focused on the tech sector. But I think, as Dixit says, China is an exporter of capital, and we've certainly seen across Europe a lot of Chinese money going into various sectors and countries in Europe, not least because I think there are some rules about foreign investment in the US which are difficult for them to navigate. I think we had some questions over here. If we can get the mic.
Hi, I am Vikas from Delhi. First of all, thanks for all the wonderful insights. But a typical question, and specifically I would like to target to Hussein. For most of these startups, the valuation gets pegged in terms of the top line, wherein it's easy to, I would say, relate the growth numbers as well, and of course, the focus on valuation. But is there any phase in this typical 10-year horizon that you have, wherein the bottom line also comes into play, or is it industry related? How do you actually value a business in terms of, or is it a migration from top line to bottom line at any stage?
So I think the way most of us think about it is the bottom line, surprisingly, is very important to us. But the bottom line is not important to us in the short run. The two variables that we kind of think a lot about are the growth, right? Building a big company, a truly big company requires investment, and it will typically repurpose all the cash that the business is producing if it actually is producing cash. And it's very rare to see growth to get to kind of the 100x level, right? So you want to, if you do have something like that, you want to focus on growth over and above everything else. The thing that you spend a lot of intellectual time thinking about, which I didn't explain when I was doing the valuations, is on the fundamental microeconomics of the business. So you worry, again, not what the business looks like today, but at scale, what does that business look like? How would it actually produce cash? And kind of the poster child for something like this would be Amazon, which ran at a deficit for a long time, but it was very clear that it had businesses, once they matured, were very easily able to produce cash, and it just kept reinvesting into brand new lines of business to foster growth. And the public markets, for a while, they punished them, kind of post-dot-com bubble, but as the markets began to understand what it was doing, the stock has appreciated quite dramatically over the last 5 or 7 years. That's the same exact way that we on the private market side would think about it. Now these things get thrown out of whack sometimes when too much money comes into the system. And so if you look at India as a poster child for this, right, there are a lot of fundamentally unhealthy businesses in the technology industry in India where they're not gross margin positive, they're not contribution margin positive, right? Their premise is that they can turn those dials at some point in the future, but not only are they losing money on the bottom line, they're actually losing money sometimes on every single transaction. And because there was, and it's pulled back now, so much euphoria that India would turn into the next China when it came to the tech industry, the capital markets basically supported that investment thesis, even though it wasn't a very sound investment thesis, and you start to see a correction. Our markets are very, very, very susceptible to cash coming in and out, which means that we get inflationary prices and you get deflationary prices very quickly because people get excited. Our job, weirdly enough, as venture guys, is when the market's willing to pay you an extreme premium over the baseline earnings, right? That's a good time to actually be able to get out. And sometimes our returns are generated in these very unhealthy environments because you effectively get bubble pricing, which inflates your multiple, which makes you a lot of money. So we tend to not try and stop this.
Thank you.
Thanks, Hussein. I think there's another question here. I think have we got time for one more question? Yeah.
Okay, thanks. For Hussein and Lord Ghadia, around Uber and what's been transpiring in the market here, is there a concern around companies which are getting big and causing competitive issues with its, let's say, inherent, somewhat archaic systems that we have in the UK? What are your thoughts? I mean, from yourself as Lord and yourself as a VC, are there issues around this current situation?
Well, let me sort of maybe kick off and give you sort of perspective, if you like, from a public policy perspective. My own view is that, if we want to demonstrate that London is open for business and that it is pro-business, that yes, we have to have high standards of regulation, which is what Transport for London is there to enforce, but what they must do is be proportionate. And I think in any other sector, if you were faced with a company that was not complying with its requirements, what you would do is impose a large fine, and you'd also put them on probation to meet up and shape up to meet certain standards. You certainly wouldn't revoke their license. And what I do find encouraging now is that given the fact that there are something like 40,000 potential jobs at risk and 3.5 million users of Uber, that message has now got to the relevant authorities and that dialogue is happening. But certainly from where I sit, I would like this resolved and Uber back meeting the needs of a lot of very satisfied customers.
So I think about it a little bit differently. If you look at the history of the tech markets, say the last 20 years, most of the successes that we had in our industry were in non-regulated environments. Didn't really make a difference. I think we're now in an era as the technology industries are touching so much more of the world that we're in mild to moderate regulated environments. Taxis are one example. And if I look forward on a 20 to 40 year basis, I think a lot of the new wealth that's going to get created in the tech industries is going to be in very heavily regulated industries like healthcare or like energy. And we as an industry have not figured out, we work at a very different pace, we work at a very different speed, we work with very different sets of rules because we are not used to being in regulated environments. And so there's learnings, I think, on both sides. And similarly, I don't think regulators know how to deal with sometimes the pace of change that folks like Uber bring to the table, where the rules almost sometimes don't apply and are legacy rules. This is something that I think is going to be more pronounced over the next 20 to 40 years because we're going to see more of the tech industry touch these kinds of industries. And I think it's going to take us 5 to 10 years as a society to figure out how to balance these two things out. So you have a win-win scenario versus a win-lose scenario.
Thanks, Hussein. I think our time is up, so I'd like to ask you to all join me in thanking a fantastic panel for their contributions.
And also thanking a fantastic moderator, Lord Jitesh Ghadia. Ladies and gentlemen, we couldn't ask for any better professional platform than this. Honestly, of what you know about the background of Lord Jitesh Ghadia, of Dixit Joshi, of Nina Amin, and of Hussein Kanji. I'm telling you, this is the most powerful session among all. Thank you so much. Thank you for coming over. And one more good news is that Miss Nina Amin is Jain, and I'm also told by our good friend, Mehul Bhai, that Lord Jitesh Ghadia and Mr. Dixit Joshi are, honorary Jains now for this friendship, which is, thank you. All right, with this note, thank you so much, Lord. This is amazing. Very nice to have you all. If you could give me one more second, we have a couple of, just a part of gesture. May I request Mr. Bharatbhai Mehta from UK to come over, Mr. Jaswantji Munot from India, Mr. Narendra Surana from India, and Ashok Bhai Shah from India to come over and do the honors, please. Mr. Narendra Surana would do for Lord Jitesh Ghadia. Followed by Mr. Ashok Shah to Mr. Hussein Kanji, please. Followed by Bharatbhai Mehta to Mr. Dixit Joshi, please. I must tell you, friends, I visited Mr. Dixit Joshi for the first time at his residence, and what an experience I had with his daughter. That's something which I'll never forget all my life. The way the hospitality, and the first question is, how do you know my father? I'm like, okay, never been asked this before. I said, okay. I said, no, through Mr. Mehul Bhai. She said, Dad is not home, but I can accompany you. I said, brilliant. She sat through, started talking, discussing about what I do and what she does. And believe it or not, this conversation we never had in India before, but I had a different perception that families in UK, they have a different way of upbringing, but I should tell you, Mr. Joshi and his daughter impressed me so much. Great, Mr. Joshi, a lovely upbringing. I truly appreciate it. And this was truly grounded, felt like I was at home in India. This is amazing. Good. And Mr. Jaswant Munot to do the honors to Ms. Nina Amin, please. Can we have a group photograph of all of you all, please? Bharat Bhai, please, can you? Yeah, Jaswant Bhai, please, if you could stay. I'll join you. Ladies and gentlemen, thank you so much. Thank you for. It's been a fantastic and very, very informative, invigorating session. With this, may I request our very dynamic, I'm telling you, most of the content which you saw running through your websites to your marketing. She's a very, very young but a dynamic personality. Did a great job. Right 2 o'clock you called Mithali. Mithali, we need this content ready, and she's up there. May I introduce Mithali Charadia to introduce the next session's speaker. Mithali Charadia, please.